It's the word on everyone's lips. Rates. Government bond rates are skyrocketing, and it's causing problems for the market, the economy, and the world. How high are rates going to go? When do we think this is going to be over? What should we be doing about it? Join me today as we discuss the rate shock on the Midweek Update.
Okay, friends, we've got a lot to talk about today, so let's jump in and talk about the rate shock. First and most important thing you need to know is that rates are rising rapidly. What I'm showing you on the screen here, this is the US 10-year Treasury rate and the US 30-year Treasury rate, and this is the interest rate that the government pays on its debt. And what you notice is from about 6 months ago, we rose from maybe 3.25, 3.5, roughly the interest rate, to where we are today, 4.75, and the 30-year touched 5% earlier this morning. This is a tremendous increase in a short amount of time. And of particular interest is in the back half of September, you can see that things got a little more vertical. This is why I think we're in the midst of a rate shock right now. The implications, what this means, is that when rates rise rapidly, it causes the market to be repriced. And the reason why this happens is when you own a stock, you own all the future cash flows that business generates. And as interest rates go higher, it makes those future cash flows, the ones that are way out in the future, it makes those smaller because of the discounting back to the present. So I'm not surprised that the stock market is having a little bit of a trouble here, particularly in the back half of September, because we're in the midst of a rate shock. Rates are just rising very rapidly, and it's tough for the market to have its footing in that sort of environment. The other important thing to note is that US debt is rising rapidly, and this is actually what I think is causing the rate shock. So what I'm showing you here, this is the total US debt, and the way I like to look at it is 2 weeks ago, we crossed the threshold of 33 trillion in total debt. Now it's 2 weeks later, and we're at 33.5 trillion in total debt. This means we're adding debt at a pace of around $1 trillion a month. And this is just way too much. It's unsustainable. We added over $250 billion in debt in just one day last week. What this means, the implications are, I believe we're hitting the limits of spending. And this isn't the government hitting their limits of spending, but remember that when the government spends money that it doesn't have, it needs to take in investment flows from other people. Foreign governments, pensions, investors, they need to buy the treasuries that allows the government to spend more than what it takes in. And so this issue, the limit on spending, it's not coming from a debt limit, it's not coming from anything on the governmental side, it's coming from there just isn't enough money out there to absorb all of these treasuries that the government is issuing to fund their operations. We're just spending too much. The debt is rising way too rapidly. Not surprisingly, if rates are up and debt is up, that means that the interest being paid on that debt is rising rapidly as well. And this sort of reinforces this whole cycle. So this is the federal government current expenditures, and this is just on interest payments. And if you look at where we were in 2009, we paid maybe $375 billion a year in interest payments just to pay for all the spending that we did previously. If you look at where we are today, we're pretty much looking at $1 trillion a year in interest payments. And this is important because total government receipts, all the money that the government collects from tax revenues and all of its other operations, is a little less than $5 trillion. So as a percentage of government receipts, we basically have 20% of the government receipts, not even spending, but 20% of the receipts now needs to go to servicing interest on the debt before providing any services, before Medicare, before Social Security, before anything like that. And so what this does is if there's not a reimagining on the spending side, what this is going to do is this is going to kind of perpetuate this cycle. And so the implications of all of this, when you take this all together, what it tells me is the US financial house is not in order. And I'm not the only one saying that. This is part of the reason why debt rating agencies are downgrading US debt. This is part of the reason why we see such dislocations in the bond market. It's because the largest player, the most liquid markets in the world, the treasury markets, are sort of out of balance right now. There's a supply and demand issue that's going on in the treasury market. So what does this all mean? Well, rising rates are going to increase the borrowing costs for everyone. If the US government is paying more on its debt, I can promise you that you're going to be paying more on your debt when you do things like take out a mortgage, finance a car, open a credit line. This is going to raise rates for everything. And so this is going to slow down the economy even more. This isn't coming from the Fed. This isn't Jay Powell. This is solely from the supply and demand imbalance in the Treasury complex. The other thing, what this means, it's hard to predict when this process will end, right? Rates are readjusting right now. We're in a rate shock, and all I can tell you is it's over when it's over. But the one thing that you want to focus on is it will end. And in this case, it's actually a very easy problem to solve. We just need to stop spending so much. We need to get our financial house in order. We have the power to do that at any time. And what this means investment-wise, it means be careful. And this is part of the reason why we've had a defensive posture all year. I didn't feel as though we were out of the woods, and seeing a rate shock like we're seeing right now is just another data point that says, hey, what happened last year, the market problems in 2022, they've carried over into this year, and we're not out of the woods yet. But as I'm telling you to be careful, and what we're doing to be careful is we're increasing the proactive monitoring on all of our positions, I also want you to recognize the opportunity, right? We know that this rate shock will end, and when it does, there are some really compelling opportunities out there in the investment space. So you don't need to do anything about it, but this is the rate shock. This is what we're experiencing, and this is why. Thanks for tuning in. I'll see you guys on Friday for the market review. Take care.